and the big money is already starting to dump. What I'm talking about in 2027 and beyond is a much larger corrective move where we could actually see that 40 or 50% drawdown. You're right at the high of euphoria in the stock market, at least. Just be aware that things will end. It's just a matter of when. You will see Micron down 75% within the next 12 to 18 months. Historically, when the Fed actually starts cutting rates, that's when the market actually starts selling off. Gold is going to 10K. Once we're below 4,000, as we go down, I'm just going to have buy orders every $100 and just start accumulating. If you see it getting down to $50 a barrel, there's something majorly wrong in the US and global economy that's destroying demand. And that again will signal likelihood of recession.
Gareth, you nailed the oil rally and then that subsequent 30% pullback. Looks like you're correct on silver and gold. And you got the Bitcoin trade pretty much exactly how it's playing out. So, what are the top 3 assets, positions, or trades that you're focused on right now?
When it's almost there and I'm starting to get ants in my pants to buy silver. Don't think that there's no nefarious kind of action going. If you're a central bank, if you're a country, you don't want silver at 120 if you're buying a ton. You want it down. They would much rather buy it at a discount and load up and get retail scared and dumping so that they can kind of swallow it up. And I could absolutely see that as being part of the issue here.
Do you see a scenario where Bitcoin goes to zero?
Oh, man.
This is The Real Story with Michelle Makori.
Hello, I'm Michelle Makori, and this is The Real Story, where we go beyond the headlines, beneath the surface, and behind the curtain to show you what is really happening with money, markets, and power. Thank you for joining us. The Trump administration is making an ambitious case for where it believes the U.S. economy is headed. Treasury Secretary Scott Bessent recently outlined what he calls the administration's 3-3-3 vision. An economy growing at roughly 3%, an increase of 3 million barrels a day equivalent in U.S. energy production and exports, and a deficit to GDP ratio eventually brought down towards 3%.
So 333, the 3 components where we could have 3% growth. I think we might have been growing at 4 in February. I think we're going to get back and we can have something with a 3 in front of it this year. As I said, the underlying economy has been strong. One of the other 3s is 3 million more barrel a day equivalents. So crude and nat gas, export LNG, which we're well on our way to. We've never produced so much energy, never exported so much. And then deficit to GDP of 3%. What we didn't get any credit for in 2025 was we had a fiscal contraction. So when we came in 2024, deficit to GDP was about 6.8%.
Now, on the surface, some of the latest economic data appears to support the idea of a resilient economy. The latest revision to first quarter GDP showed that the U.S. expanded at an annualized rate of 2.1%. That was stronger than previously reported. But beneath the headline, the picture becomes a little bit more complicated. That upward revision was driven in part by a decline in imports, which mechanically boosts GDP calculations. Meanwhile, consumer spending, the engine of the U.S. economy, was revised sharply lower to just 0.5%, pointing to much softer underlying demand. And at the same time, inflation appears to be heating up again. The Fed's preferred inflation gauge, the PCE price index, accelerated to 4.1% year over year. That is the highest reading in more than 3 years. And core PCE, which excludes food and energy, climbed to 3.4%, the highest since October of 2023. So is the U.S. economy really strong enough to absorb persistently high inflation, elevated interest rates, and potential tighter financial conditions? Or are we looking at a late cycle economy where the headline numbers look resilient, but the consumer is weakening and inflation is accelerating again? Well, my next guest says the U.S. is heading into a stagflationary environment in the second half of this year. And he's been remarkably accurate on several major market calls this year so far, including on oil, silver, gold, and Bitcoin. So what is he forecasting next? Joining me now is Gareth Soloway, Chief Market Strategist at Verified Investing. Gareth is a widely followed technical analyst with more than 2 decades of trading experience. He's known for his disciplined chart analysis and bold contrarian calls. He combines technical analysis with macro fundamentals to help investors identify both opportunity and risk. Gareth, great to have you back.
Oh, it's so wonderful to be back, Michelle. Thank you for having me.
Well, Gareth, we're going to start off with another big victory lap for you. We will begin with oil because you have been very accurate on oil. When you joined me at the end of last year, end of 2025, you said that energy was shaping up to be one of the biggest trades of 2026. You talked about geopolitical tensions and capital rotation into energy. You called that big rally that we had in oil and oil-related stocks that we saw earlier this year. Then when you and I spoke in mid-March, around March 13th, oil was trading around the $100 mark. And you said that the oil rally had gone too far and that within 3 months, we would see prices back below $70 a barrel. Well, WTI briefly traded below $70 this week before recovering slightly. So again, that was another remarkably accurate call. And here's just a recap of your oil call in mid-March.
My guess is we're nearing a topping point in oil. I actually think at this point you dump it, you move back into other asset classes, although it's tricky to find them, but we'll go over them. I think oil, again, within 3 months is back below $70 a barrel. Demand destruction is going to play the biggest role, and eventually we're going to figure out a way to open the Straits of Hormuz.
The Oracle of Oil, I think, is what I'm going to refer to you from now on. Oracle of Omaha, Warren Buffett, we will make you the Oracle of Oil and perhaps other things because you've been correct on other calls as well. But let's begin with oil. And again, West Texas Intermediate briefly trading below $70 this week before recovering slightly. Crude at around 70, 71. So where is oil in your outlook right now?
Yeah, so oil has basically come back in to fill the gap or just about fill the gap that we started with just before the war that began between the US and Iran. And so what we're going to see now is likely support on oil between $65 and $70 a barrel. I've actually inched into a small long position in the last couple days on oil. If we look at the chart here, I'll take you guys through it. And what we see here on the charts is that we're looking at major support. Here's that level right before we had the surge up. And notice how we've now come down to what we call the gap window right here and the gap fill right below. And so on a technical basis, this should be support. As long as the US economy holds up, it's unlikely for us to go through and down below this level, especially because there's so many strategic reserves that have been depleted. So what we're going to see is a lot of these countries, including the US, saying, all right, well, oil's back below 70 or in the 70s. Let's start refilling our reserves in case things erupt in the Middle East again and the strait is closed. And so for me, at least, I look for a short-term bounce. Again, this is not a bigger macro call of that we're going to go majorly to the upside. I'm just looking for a technical float back to about $80 a barrel. And then for us to kind of hover the remainder of the summer and into the fall between that $70 and $80 barrel a level. And then the key is going to be, do we eventually see the macro economy weakening, which I do think happens late this year? And that's the trigger for oil to break below that $67 per barrel level.
All right, so let's talk about the macro because oil sits at the center of almost every macro conversation. As we know, it influences inflation, the Fed, consumer spending, corporate margins, of course, ties into geopolitics. So when you look at the oil market today, what is the story we should be thinking about in terms of where the U.S. economy is headed?
Yeah, and that's going to be the real ticket, right? Is that, in other words, when we're looking at oil, we have a scenario here where oil, again, likely holds steady. We see all this CapEx spending from the AI trade and everything going on there. And to me, that's really propping up the economy. You mentioned at the start how consumer spending is starting to fall off a cliff. I think you'll get a small rebound now that oil has come down significantly, but I don't think it's going to rebound to pre-Iran war levels, mainly because the consumer continues to be under pressure. Now, the GDP, like you said, is partially an import-export issue there, but I also think that there's an underlying issue where you have a majority of Americans struggling, getting deeper in debt, still trying to spend, but running up credit card debt. We see credit card delinquencies, auto loan defaults starting to rise more and more. And that tells us that eventually late in the year, we start to see weakening in the economy. And that is going to be a trigger for oil going down to possibly as low as $50. So again, we'll have to see if I'm the oracle of oil here, but I could see by December or maybe early in 2027, oil down to $50 a barrel.
$50 a barrel for oil by the end of the year, but you're saying that's not necessarily going to be a good thing. That's going to be a reflection of a slowing economy.
That's right. That's right. And that's going to be the negative here is that, I mean, there's a lot of talk about how we want to get oil prices down. Well, granted, you've got them down now to $70 a barrel. That's a solid level. Like that's a manageable level. If you see it getting down to $50 a barrel, there's something majorly wrong in the US and global economy that's destroying demand. And that, again, will signal a likelihood of recession.
All right, let's focus on inflation here for a bit. Obviously, oil feeds into that picture. We saw that the PCE price index just rose to 4.1% year over year, the highest level in more than 3 years. Core PCE, again, which strips out food and energy, oil climbing to 3.4%, the highest since October of 2023. So what is your read on inflation here, even with these lower oil prices, and more specifically, what it means for the Fed under Kevin Warsh?
Yeah, so overall, I would expect inflation to moderate, but I think it's important for us all to remember that inflation was already going up prior to the war between the US and Iran and the spike in oil. So I think we have to be understanding that inflation is not transitory here. It's not just an oil story. Sure, oil added to it. It pushed it much, much higher than it probably would have been, but it's still an underlying issue in the US economy, and it's not likely to go away any time soon. And I think this comes back to where we were talking about potentially late this year, early 2027, where we get into that stagflationary environment where we start to see inflation maybe not down to 2%, but it could be around 3%. But at the same time, the economy slowing more and more and potentially going into a recession. And again, that's the definition of stagflation. And I do think we're still on course to see that year end or 2027.
Okay, but you don't see us hitting a recession, as in 2 quarters of negative GDP growth by the technical definition, until maybe 2027. You don't see that happening. Or what is your outlook for when you see that happening?
No, and I agree. I think that the 2 quarters consecutive, that'll be into 2027. I mean, that's pushing it out 6 months from now. And we know the GDP numbers just came in today. So it probably at least takes us into probably the midpoint of 2027. And I think we have to look at it like this, is that the spending alone, I mean, you have government spending that obviously hasn't really stopped or slowed down. It's accelerated, if anything, with the cost of the war. But obviously we're looking at, military spending, rebuilding the military aspects that were used up during Iran, in the Iran war, as well as in Ukraine. And so that has to be built up. That's stimulative. Then you have the CapEx from the AI trade that's going on. That's unlikely to slow majorly before year end. But I do think you are starting to see the signs in the AI trade that things are getting long in the tooth. And some of these stocks like NVIDIA and Broadcom are already showing signs of a potential bear market.
Right. Well, before we unpack the AI trade, including NVIDIA and Micron and some of the other names there, with this outlook that you have for the macroeconomy, what does this mean for the Fed? Because the idea, well, that the public is buying right now is that we have a new Fed regime.
Mhm.
And it seems as though, despite the fact that President Trump made it very clear that he was unhappy with Jerome Powell because he wasn't cutting rates, that Kevin Warsh will have free reign to do what he wants with the Fed, and that he is being perceived by the markets as being relatively hawkish. And again, he is making it very clear that markets are not going to be getting extensive forward guidance from this Fed. So what's your read from what we can expect from the Fed?
Yeah, I think the market misread the Federal Reserve speech, the press conference where Kevin Warsh was hawkish, but I'm not buying it. I think it was a majority of an act that he was putting on. He has to put on that strong force to say he's going to tackle inflation. But we know that President Trump said that he would never appoint anyone who wasn't willing to cut rates. And that puts us in a position where Kevin Warsh had to be hawkish. He had to kind of say, hey, we know inflation is high. We're going to tackle it. But at the same time, I know the markets are pricing in a rate hike before year end. I don't think we're going to get it. And I think he is going to become more and more dovish over time. And remember, he's the one that's floated ideas about redoing the inflation gauge and getting rid of outliers of inflation. And so you take out like the outlier popping up and all of a sudden inflation looks a lot lower, and it gives you a case for the Fed being able to cut rates when maybe otherwise they wouldn't.
Right. He is implementing 5 task forces to look at a number of things, including how inflation is calculated, including which data is being used. And that could, in fact, set the scene to say, oh, well, actually, this is the real inflation number, and it's okay to cut into this inflation number. One of the interesting things that people have been buzzing about is the fact that he declined to participate in the Fed's dot plot projections. He signaled that the Fed will place less emphasis on providing detailed guidance about the future path of interest rates at large. He had a shorter, simpler policy statement. He wants to rethink how the Fed communicates with markets and the public. Now, right or wrong, that's a whole other matter. I mean, many people have been saying, that the markets have been moving the Fed has been moving the markets, that this has become this a cycle that is very divorced from the real economy. But either way, we're going to probably get greater uncertainty for investors here, because for years the markets have become accustomed to the Fed providing increasingly detailed signals about its future intentions, acting on what they think the Fed is going to do, all of this sort of preemptive positioning passing through Fed statements. When we have a more opaque Fed, is that safe to say that that creates more uncertainty and market volatility often go hand in hand? So where do you see the markets under this new Fed regime?
Yeah, and I agree with you on this, is that the less communication, I mean, it was often looked like, wait, is the Fed over communicating? But the one thing that I'll say about the former Fed regime is that if there was any hiccup, there was always a Fed official that was giving a speech or the press conference after the Federal Reserve decision. It was always a way for the Fed to calm the markets down or correct the markets if they were making a misinterpretation of what the Fed was doing. And we saw Jerome Powell, a master at this, always calming the markets down. You would see initially some uncertainty after the rate decision, and then he would come on, give a press conference, and the markets would generally go up because of his demeanor and because of his calming nature. And so anytime you cut that out, or somewhat of that, I do think it raises the odds of more intraday volatility and even intra-week and month volatility. And I think it's, for us as a trader, I'm more of a shorter term trader, that actually is a positive. But I think for the retail investor, it does bring up more potential risks and volatility.
Right. I mean, again, you could argue that the Fed's mandate is not to watch what the markets is doing. In fact, it's definitely not. And that perhaps was not a good thing. But here we're going to have this environment potentially of a less communicative Fed. Now, you said despite all of that and despite what Warsh is saying, you do see, not a rate hike, but are you forecasting a rate cut or just a Fed staying steady? What is your Fed forecast, especially if you're seeing a stagflationary environment creeping in towards the end of the year?
Yeah, and so as soon as the economy starts to stall and slow, I expect a rate cut. I think the markets will already see this in the future. We'll start watching the 10-year yield and seeing where that goes. But my guess is no action by the Fed into year end. And then I think in the first quarter of 2027, we will get our first rate cut.
Okay, and then what does that mean for the markets? Because if we have stagflation, but then we have a less hawkish Fed than we're led to believe, what does that mean for the general market and where you see it ending the year?
Yeah, so I think the markets will end lower than they are currently. It's hard to know with the CapEx spending and the AI trade when that fully is going to tap out. I do think we're seeing lots of signs already of it tapping out, but I would generally expect a lower than now close to the markets. And then I think we're going to start to see more downside in 2027. Historically, when the Fed actually starts cutting rates, that's when the market actually starts selling off. And most retail investors, they're under the interpretation that lower rates of Fed cuts are positive. But when it's combined with a slowing economy, the fear starts to become pervasive. Oh my goodness, we're going into a recession. The Fed is behind the ball. They should be cutting more. And that's where you see investors starting to run for the hills. And especially at these levels where everything's priced to perfection, we look at all of these metrics in the AI trade and we're seeing, everything's priced like the demand will never slow, the CapEx spending is just going to go up. We're starting to see cracks in that narrative.
Well, last we spoke, you said you saw a 20% S&P 500 drawdown by the end of the year. Is that still your outlook?
I still think that's a possibility, and we did get a down one of almost, I think it was about on the S&P about 7 or 8% before this latest push up. I still think that is a possibility, but what I'm talking about in 2027 and beyond is a much larger corrective move where we could actually see that 40 or 50% drawdown. But yes, short term, absolutely. With, basically, if you have a correction in the AI stocks of 20 or 30%, which is kind of the run of the mill, just pullbacks in those stocks, that would be enough to take the stock market, at least the NASDAQ, down well above 10% down, maybe even 20%.
Okay, but for 2027, you're seeing as much as a 50% drawdown?
I do. Yeah, I do. I think that, again, as we get further down in this cycle, there is going to be some major questions asked about the sustainability of the CapEx spending and how far things have gone. And think about the rush of liquidity. I mean, we've seen SpaceX come public. All right. Now we see SK Hynix is dropping $29 billion of shares that they need the US investor to buy. We have Anthropic, OpenAI, Perplexity. Google's tried to sell or is in the process of selling $80 billion. I mean, eventually the liquidity in the system is going to dry up. And I think we're already starting to see that. And at some point when it runs out, when you get one little tidbit of negativity, that's when the markets can fall. And think about this, just in the last few days before the Micron earnings, we had a little bit of questions on the AI trade. And look at how fast the markets went down. I mean, we literally woke up to a 3.5% drop in the NASDAQ just a day or so ago.
Before we continue the conversation with Gareth, I just want to take a quick minute to thank you all so much for watching and supporting our work. Please make sure to subscribe to the channel if you haven't already, and do set your alert notifications. And please share our content. I really appreciate you helping us grow this community. And if you would like to learn more about precious metals and get a customized precious metal strategy that best suits you and your needs, you can reach the expert team of brokers and advisors at info@milesfranklin.com. Also check out the website, milesfranklin.com. Now back to my conversation with Gareth Soloway. And yet, just to play devil's advocate here, and you can pull up the Micron stock, Micron's blowout quarter has for now dispelled concerns that the AI boom is faltering. The revenue in the 3 months to May was more than 4 times higher than the same period last year. Micron hauled in $18 billion of free cash flow in that time. Micron's had a phenomenal run. Investors seem to look at these earnings and say, AI trade looking solid. What's your read?
Yes, and it's always important to kind of not focus on the shiny thing in the room. And right now, Micron is the shiny thing. We see it right in front of us, right? Here it is. Today, it made a new all-time high. Couple things to note is that ultimately they are projecting out all this grandiose promises about AI demand for memory. Prices are going to stay at crazy levels with margins at 85, 90%. I don't buy it. And I'll tell you, we're already seeing other companies starting to pursue DRAM and memory production. We're seeing other plants being built. And granted, that's not going to come online for a year or two, but it will come online. And these things are cyclical. You will see Micron down 75% within the next 12 to 18 months. And keep in mind, Micron's the shiny thing, but look at NVIDIA. All right, is the AI trade really okay right now? NVIDIA just made a new low today with Micron going up, 15%. We have NVIDIA down today on the day. Look at Broadcom AVGO. AVGO is down 20% off of its recent highs. And a lot of these other AI stocks that were hot just a week ago have stalled out. MRVL, take a look at this one. MRVL still hasn't been able to push back up and barely closed green on the day. And so, granted, Micron, they were awesome. That move is incredible for $1 trillion+ company to jump like that. But if you look at the underbelly of the bigger players, not the shiny thing, but the actual real backbone of the AI trade, it is starting to falter, and eventually it will spill over to Micron.
Did you say Micron down 75%?
Oh yeah, yeah, absolutely, and that'll be kind at this point. I mean, that'll happen. And again,
Talk me
please.
through that. Show me that on the chart.
Okay, let's talk about this. All right, so let's go to Tesla. Now, Tesla, this is a great example. In 2021, Tesla was the equivalent of Micron, the hottest stock. I was trading this, I was shorting it up in this range. I was getting crushed on my short. It was trading up here. It kept on going up and up. Kathy Woods with her crazy valuation saying it's going to go up here, 4,000, 5, whatever it was. And look at what the drawdown was. And this is very standard. You look at this 75% drawdown between the peak of 2021 and the low of 2023 in January, basically 1 year later. You go to Amazon. Amazon, if we go back to the 2001 bubble top right here, we go back here. What was the drawdown on Amazon back then? And you can go to Cisco. This was 95%. But if we go to Cisco Systems, which is probably a better comparison from the dot-com bubble, look at the drop on this thing. And Cisco Systems, by the way, fantastic company, but it still dropped 86%. And so people have to understand is, I mean, this is, for me, Micron is literally oil at $120 a barrel right now. All right. And it's silver at $120 an ounce right now. And you will see the drawdowns of going back to silver heading to $50. Oil obviously came back to $67 to $70 here. That is Micron's future. Again, I don't know if it'll go a little bit higher first, but it will come down. I mean, look at this chart, Michelle. Like, how ridiculous is that? I mean, this stock is literally up from a year ago. It has rallied a massive, and let me just get my trend tool here. It has gone up 1,800%. And so that is just not the reality. That's a meme coin. Mm-hmm. And so again, you could say, well, there's real demand. All of these factors, doesn't matter. It's emotion driving price, and it's cyclical. And then when the cyclical side comes down and there's plenty of memory, margins are going to go back to 5 to 10% from 90%, and these things will crash down 75%.
Over what period of time?
I would say
a sudden drop.
At some point in 2027, so probably about a year from now, we will see this down 75%.
Okay. So there'll be opportunities to get out of Micron.
Oh yeah, yeah. Don't get me wrong. It's not like it's going to happen tomorrow, and I don't want people watching to freak out. This could even go higher in the next few days. I mean, it got upgrades today and all that. Although keep in mind, upgrades at these highs usually are topping signals when all the analysts are chasing and upgrading to ridiculous targets. But again, it's not like it's going to deplete and collapse in the next day. This will take time, just like with Tesla. It took a full year for it to go from its 2021 highs down to its lows. And then it was a great trade again. Again, the cyclicality of how investors think and the human psychology.
We'll get into the psychology, but let's talk about what could knock Micron down from its perk at the moment. And I believe that could be the debut of SK Hynix,
Yep.
which is a South Korean company. So talk us through that, why you're seeing that could be something that destabilizes this astronomical rise for Micron.
Yeah, absolutely. And so SK Hynix, you're right. So what they decided to do is they want to be listed in the US. Now, keep in mind, SK Hynix has a lower valuation than Micron, meaning it's technically a better value than Micron. And they're going to list as an ADR on the NASDAQ, which is Advanced Depository Receipt. It's how foreign companies list. And they're going to sell $29 billion in stock. And remember, the SpaceX IPO was about $75 billion. So this is almost half of what SpaceX did. And they're going to be dumping that, wanting US investors to buy that up. Investors in this market after Micron will absolutely buy it up. But again, what does it do? They do the exact same thing to a T what Micron does. And so the thesis here would be that some investors in Micron will say, well, SK Hynix, I want to split up my position. Let me sell half my Micron, put the other half in SK Hynix and diversify. And that could be another drawdown on Micron over the next month or so. And remember, this launches July 10th, supposedly. It will start trading.
Right. So you could make the case that one should get out of Micron before July 10th.
I think that makes sense. Although just keep in mind, if that's going to happen, it'll likely happen in the days pre IPO, if you will. And so a great example of this, and I love being able to give examples. If we look at SpaceX, obviously horrendous performance on SpaceX. If you got it at the IPO level, meaning $135, awesome. If you're anyone who bought it afterwards, you're basically down on your investment at this point. But look at the other space stocks. They ran up to April or May 28th, and then they started to sell off as people started to sell them so that they could free up capital to buy SpaceX. And look at the performance on AST Space Mobile, or you have some of these other ones like Rocket Lab, RKLB. That's another one here. They have all started to collapse down. And so basically the hype meets the SpaceX IPO like it will probably with Micron. And just in the days prior, Micron will start selling off as people start to raise capital for SK Hynix.
Well, we still have other big IPOs slated for the second half of this year. We've got Anthropic, OpenAI as well. How do you see those going, and how do you see that impacting liquidity in the market?
Yeah, and I think that's incredible because we're talking about another $1 trillion for Anthropic, close to $1 trillion in OpenAI. Number one, the government better keep printing money so there's enough liquidity for the absorption of all these shares that are coming to the public. Obviously, I'm saying that somewhat in jest, somewhat not. But the point here is that this is a hot market. This is the type of market where SpaceX was supposed to go public late in June. Instead, they rushed it to the market because they said, we got to get this out so that the market has the appetite for this stuff right now. They're trying to rush Anthropic now, and they're trying to rush OpenAI. So I think you'll see these public sooner than later because they know, institutional money knows that time is thin here. It's running out. And if they don't do it quickly, they are going to lose out on their opportunity to get the best price. And I think they're even looking at the SpaceX IPO debut and saying, that's not the best result. That's not how we wanted this to go. We better either get this out soon or we're going to have to hold off on our IPO.
Right. You posted in June on X, Gareth, that the concentration of AI stock market cap, just the top 25, now accounts for almost 42% of total US market cap. For comparison, .com concentration was 37%.
Yeah.
So are you forecasting a big bubble burst? What do these numbers tell you?
It does. That's exactly what it does. Is unfortunately we're human. We're made to tend to repeat our mistakes. We forget 26 years ago what happened in the dot-com bubble. There's so many new investors, so they think again this time is different. I heard that exact same term in 1999, 2000, and to some extent it was. The internet changed all of our lives, but the human psychology that drives things up, it doesn't change. And when you see the concentration in these names that is built on this will never end. The demand will be insatiable. The prices and the margins will always stay at these levels. That's concerning. And that's where you start to say, okay, listen, at some point, and by the way, we already saw it today with IBM. IBM came out with a new chip that's less than a nanometer. And what did we see? We saw Broadcom selling off, and we saw NVIDIA selling off. And so competition for the chip sector is already heating up. It's going to push margins lower. And that's eventually what's going to happen to those memory stocks like Micron as well, where margins aren't going to stay at 80, 90%. They're going to come to 50%. Now, how do you price it? At this level, if margins are at 50, do you have to cut the price in half to 50? That's likely what's going to happen with a lot of these stocks. And you'll see as this sector is commoditized, it will go back to a more normalized 10 to 20% of total market cap of the market.
By the way, we just have some breaking news as we're talking about OpenAI and its IPO. According to the New York Times, OpenAI now leading towards holding off on its IPO until 2027. The New York Times is citing 3 people involved in the company's deliberations. Bankers advising that the ChatGPT maker should take a look at the recent volatility in tech stocks as well as in SpaceX shares following its record IPO, and that could dampen enthusiasm from retail investors for OpenAI's offering. That's headlines coming in from the New York Times. We'll see if it's accurate. Again, they're citing sources close to the matter. I guess it... Go ahead.
I was going to say that makes total sense, right? I mean, if you look at how SpaceX has performed, it's basically at the opening level, meaning it popped up on the crazy enthusiasm of investors and then came right back in, and it likely will break lower. And then, if we could go back to my charts, just to show this one, CBRS.
We love your charts, Gareth. Pull them up any chance you get.
Awesome. So here, look at this. This was a chip, the semiconductor IPO. It was given to insiders at $185 before it went public to the public, right? Before it IPO'd. It opened at $350. It went up to $380. it's literally trading below even what the insiders, the people that got the shares before, at $185. It's now trading at $169. And so if you're Anthropic or you're OpenAI, this is not what you want to see. And now you have, we talked about this before, Google pushing out $80 billion of share sales, other companies doing the same, SK Hynix dumping $29 billion. Investors are getting worn out. They're struggling. Many of people are struggling filling up their tanks, right? I mean, yeah, gas prices are coming down, but the bills keep coming in. And now you're saying, hey, let's dump even more money on the market. I'm not surprised that OpenAI is thinking about postponing it.
So if money is going out of these AI stocks, according to your forecast, where is it going into? Where is the
Well,
capital rotating into?
yes, and that's the big question, right? So I do think that we're seeing some money move into the bond market. If we look at the 10-year yield, the 10-year yield is actually breaking down here on the chart. So again, we're starting to see, this is telling us that there's a rise in interest in buying into bonds right here, that interest rates are starting to come in. And again, this trend line here, you could see this was a great breakout and now it's failing. Now, again, this is two ways to take this. Number one, oil coming in tells us inflation is coming down. So expectations of rates being up so high don't need to be. But also, is it telling us that there potentially is the bond market saying a slowdown is coming late this year or early 2027? And maybe we won't get rate hikes, which is what I just talked about before. So the bond market may be leading us here just a little bit. Now, in terms of money rotation, the US dollar is king again. I mean, look at this move up in the US dollar. Incredible. Now, it did hit resistance, but there's definitely a resurgence in the US dollar, which is also partially why we've seen gold and silver take such a massive dump. But for me, I'm just looking at rotational capital, right? I mean, we look at, again, this is one I've talked about before, but I'm going back to old trusty. I know people are like, these stocks are so boring. Who cares? Yeah, but it pays a 10% dividend. And it's at literally a decade, multi-decade lows on the chart of ConAgra. People still have to eat, even in recession. And so, if someone's going to pay me 10% and I have upside potential on the stock, I'll put a little bit of money to work in these type of names.
Okay, we will get your top opportunities that investors could be missing out on, but we're going to save that till the end of this interview. Keep our viewers hanging on. You mentioned the metals. Obviously, they have taken a hit. Last time you were on, you made some of our viewers very unhappy with your call for silver. You called for $50 silver. Silver's at around $56. Again, let's hear where you are on where you see the silver market towards the end of the year, ending 2026.
Yeah, so the key here is, and listen, I know I upset people by talking about it going down to the 50-ish level, give or take. Number one, it's almost there, and I'm starting to get ants in my pants to buy silver, right? So the first key level is this pivot point here at 54. That'll be first support. I don't know if it will hold, but that'll be starting where I start to nibble. And then really at a pierce of $50, that's where I want to buy. Now, the rebuttal I always hear, right, is that, but inflation adjusted silver should be so much higher. You're 100% right. But remember, folks, silver, gold, that in the short term, things move on emotion, which is right now fear, and that drives price below where it should be. And just like greed, when we were at 120, you could argue that it shouldn't have been up there that quickly. Longer term fundamentals absolutely matter. And so, again, obviously, I'm looking to be a buyer on gold around 3,500. We'll look at that in a minute. But silver around this $50 level, we're now getting in a range where I feel comfortable that it's at a discount to where it should be over the longer term. And I'm starting to get very interested in being a buyer.
So you're going to be buying silver as you see it still moving downwards, but where does it go from there?
So I think that, again, you get in this 54 to 48 range or so down in this range. And by the way, where am I getting that lower range? That would be revisiting our 1980 highs as well as our 2011 highs. And just in terms of a quick lesson in charts, when you have a trend line that is hammered on in technical analysis and it finally breaks out, there's this inevitable want for it to come back to home base. Think about a kid who goes away to college and then they come back and live with their parents after college, or they come back for Thanksgiving or Christmas, right? There's just that inevitability that it oftentimes comes back to that level. And that's what silver's doing. Very normal human psychology reaction. After that, we start our next trek up. I think that's where the fundamentals over the next year or two start bringing silver back up towards the 90, 100 level, eventually taking out 120. And I still think 150 within by 2030, 20, even $200 is very doable on silver. Again, I'm not looking for these parabolic moves like we saw here, but just fundamentally, you can make a case that eventually it revolves around that 150, maybe even 200 level.
You're saying $200 silver, but by 2030.
Yeah, and again, when I project out so far, right, 4 years out, 3.5 years out, it's so hard to really know. It could be by 2028, 2029. I'm not expecting silver to just rip up to 120 again after it gets to 50, right? There's a lot of technical damage. People that bought in at 100 are going to be panicking when it gets back to 100 to dump into that and say, thank goodness I'm back to my break even. That's human psychology as well. When we get crushed on a trade, we're just happy to get out break even, and you will see some of that. So it's going to have some work to do to get back to the upside. But I do think, again, once we get up there to that 120 level and break out, you'll see 150 and 200 very, very quickly again. But again, I'm giving myself a little leeway on this call, Michelle. Let's give it till 2029, 2030. That's really only 3.5 years away. It's not that far away.
I will give you some grace. You also say that you're right 70% of the time. Isn't
Right.
that your statistic? I mean, maybe this is the 30% of the time that you're not right. We'll
Absolutely
see.
could be.
But on that note, help me understand why the fundamentals here do not drive this higher. Because I get you're looking at the charts and you've got your trend lines and you've got the fear and you've got the greed. But then people will say, but the fundamentals for silver are just not the same as they were in past cycles with this industrial demand really ramping up. Again, the AI infrastructure, the data centers, the grid expansion, the electrification. I mean, these are not cyclical or optional trends, is the argument. Of course, you've also got the photovoltaics, the solar, that we are also in a supply deficit of at least 6 years, according to the Silver Institute. You look at the technicals and you look at the lines and the sentiment, but when do the fundamentals start to override this?
Yeah. And I think what we need to see is a flush out of what I call the weak hands, right? And this goes with gold as well, is that when you had people jumping in because they thought it was a get rich quick thing on silver and gold when it was going parabolic every single day, those people need to be flushed out. The old school, and I, not to date myself or whatever, but those of us that have been in gold and silver since the teens, the early 2000s, we understand that gold is a safe haven. It is meant as a hedge against inflation, against the US debt continuing to climb. And eventually it will play out in the long run. But we can't expect it to go up 100% every single year, right? I mean, that's just not the way it's going to work. So I 100% agree with you. The fundamentals say eventually up, and I agree. And that's why I'm looking to buy in this lower $50-ish range. But at the same time, the fear of people that are stuck in this trade. I mean, think about how many people bought between even just $100 and $120 that are now feeling the pinch, that are getting ready to throw in the towel. And so that's the fear. The fear is it's not the sexy trade anymore. It's got to be dumped. They're going to eventually throw in the towel. And when they do, that's that final flush out. We get a bottom and then we start trading back. I think by the way, I think by year end, we're back to $75 to $80. So there's actually some really good upside in silver here. It's just you got to get rid of these weak hands.
So $80 silver by the end of the year. Gareth, what do you make of the fact that there is more demand for physical silver, and it's not just the futures contract, it's not just the options, there's actual delivery taking place at an increasing level of physical silver, which leads not into that industrial discussion that we had, but also as a monetary tool, which we know silver does have that dual property. And we also have these exchanges opening up outside of the West, in the East, which people are saying, there's been an ability to manipulate the price of silver through these derivative markets, predominantly COMEX and LBMA, and that is no longer going to be as easy to do when you have these other exchanges opening up in the East, and those exchanges are actually resulting in physical delivery. How does that impact the way you're seeing silver?
That's really important. The physical delivery is so important. So many people buy, and now we have these perpetuals on stocks and even on Bitcoin, and it allows people to basically trade the underlying asset without actually owning it, right? I mean, without actually having the physical asset in their hand. And I think that, again, if you could get rid of that, then these metals would instantly be up significantly. I don't think they're going to get rid of it, unfortunately. It looks like they're trying to. The other thing I'd point out, too, is don't think that there's no nefarious kind of action going. And I talked with Andy the other day about this, and it was fascinating, and I agree with him, is that if you're a central bank, if you're a country, you don't want silver at 120 if you're buying a ton. You want it down. So you're going to do your best. And we still see central banks buying gold and silver, but they would much rather buy it at a discount and load up and get retail scared and dumping so that they can kind of swallow it up. And I could absolutely see that as being part of the issue here. So there's lots of things going on. We see insider trading. I mean, even on Micron, yesterday at 310, it was at 990. And for the rest of the day, it soared back up to 1050. And then miraculously, the earnings popped it to 1250 today. There is insider information leaking out in every which way at record numbers. Not saying it hasn't happened before. It's always happened, but it's so obvious now in the charts. It's at such a magnitude that in silver and gold, I'm sure there's some of that where let's put some negative stuff to push price down with retail, scare them out as we just buy up underneath. So if you're a long-term investor, just focus on the fundamentals. The fundamentals is golden down the road. That's where you got to look.
All right, let's take that opportunity to shift into gold. Another controversial call that you made last time you were on, you saw gold at 3,500. It has broken 4,000. Talk us through your gold outlook right now.
Yeah, so gold, if we look at the chart here, this did come into some key support. So notice this beautiful trend line, high pivot here, low, support, support. Every time it hits this line, it's getting a bounce, and we have this beautiful downsloping trend line. And so what this is creating is what we call a wedge pattern. Wedge patterns squeeze price tighter and tighter until it explodes in one direction. Now listen, if it breaks above this trend line, which currently sits around 4,300, then I honestly might say to you, we might not get to 3,500. We might have broken out. But on the vice versa side, if we break this 3,090, 80 level here, we probably trade down to this major support at 3,500. To me, that would wash out the weak hands that we were just talking about, people that bought gold thinking it was a get-rich-quick meme coin, when in reality, it's an insurance policy against all the crazy stuff we see with fiat and these governments out there. But right now, I'm still leaning towards the downside. I don't think we've been fully flushed out on gold yet. And I will say this, and we talked about this just before we went live, Michelle, is that, once you're below 4,000, at this point, between 4,000 and 3,500, it becomes a rounding error. I believe gold is going to 10K, probably at the same time as silver's at 200 or so. And so if that's the case, what does a few $100s mean at that point? In other words, once we're below 4,000, as we go down, I'm just going to have buy orders every $100, a little bit, a little bit, a little bit, and just start accumulating for that longer term horizon move that I do see coming. And again, how do you not like physical gold? I mean, physical gold is the way that for thousands of years, people have said this is real wealth. Governments have come and gone, civilizations like the great Rome has come and gone, and you still have gold as a store of value. So I think from now on, you below 4,000, it's a buy.
How did we get to 4,000, considering we had that astronomical rise in gold and central banks kept on adding to their hoards? And I mean, retail interest, sure, but the smartest money in the world is loading up on gold. Yeah. What do you make of the fact that we dropped to 4,000?
Well, it's so interesting. It's to me, it became a risk-on trade. And it's never meant to be a risk-on trade. We would see NASDAQ up, gold jumps up significantly, right? In fact, if you look at, the highs here, it kind of coincides with earlier in the year on the S&P or the NASDAQ. If we look at the NASDAQ, you go back to earlier this year, we were kind of right up in that upper range too. And so I really look at gold and just say, hey, listen, people, again, bought it for the wrong reasons. They saw it just ripping, and they bought into the narratives that were being spun, which, by the way, I believe in those narratives, but it hyped up too many individuals to jump in. And again, it was all those reasons, central banks buying, et cetera, and it just pushed it up too much. And there's this, what we call a rubber band effect in charts, where when you pull that rubber band, the tighter you pull it or the further you pull it, when you let it go, it snaps back. And so if you get a bunch of people to buy into gold at the highs, 5,000 or above, and then all of a sudden the bottom drops out, those sellers then are going to push it down significantly. And I think that's what we've really seen here. We've seen, again, the risk on trade has been deteriorating. We've seen less and less. If you look at the stock market breadth, it's been more and more negative, even though you still have a stock market near all-time highs. We know it's just a handful of stocks at this point keeping the markets up, and gold is reflecting that. Now, eventually, I think gold flushes out those weak hands like silver and becomes a risk-off trade where people start buying it again and pushing it up as the stock market comes down.
Well, we did have gold doing exactly what gold is supposed to do during this war with Iran, where you had central banks like those of Turkey selling their gold in order to be able to support their currencies and finance oil purchases. We saw some gold selling coming out of the UAE as well. So that is what you have gold for, to be able to liquidate quickly and easily in cases of emergencies like that. But what's interesting now is we had this debasement trade coming out from the banks last year saying that people are piling into gold and Bitcoin because of debasement and devaluation of fiat currencies. And we had a curious article coming out from Bloomberg saying that the debasement trade is now fading. Again, that was the trade that pushed investors into gold and Bitcoin and away from the US dollar on fears of inflation, deficits, debt, loose monetary policy, eroding the value of fiat currencies. And according to Bloomberg, the debasement trade is losing momentum because of President Trump's nomination of Kevin Warsh. It says that's when it began to start losing momentum, because Warsh had supported lower rates, but his reputation as an inflation hawk has changed market expectations. And they're blaming or citing that as the reason that this debasement trade is losing some of its shine. Is the trade really dead? I mean, nothing has changed, really. Currencies are still being debased. Why do you think a Bloomberg comes out with that sort of article saying debasement trade backtracking or on hold?
Well, I mean, it's tough to know whether they're, pushing a narrative that is going to drive gold down so that institutional money can start to buy, or if it's just that this now looks like the narrative. But like we talked about earlier, I don't buy that Kevin Warsh is all of a sudden coming in as a hawk. I mean, President Trump is not going to mess that up. Think about what he went through with Jerome Powell. He's not going to put a hawk in there that is not going to do his bidding essentially when the time is right. And so I think that, again, this narrative shift is feeding right into the kind of the flush out the weak hands type play. And that's going to push gold down, which gives me and institutions that I even talk with and such, they're looking to buy gold. They're just looking at this sub $4,000 level. And I think, again, maybe that's part of the issue here is you're getting that narrative flip, which is pushing gold down, but it's just feeding right into the institutional buy side.
Well, part of the debasement trade was also Bitcoin. Right. And you were spot on with your call on Bitcoin last time you were on the show. In fact, we can play that clip.
I think there's a trade here to 80 to 85,000 over the next couple of weeks on Bitcoin. And I want to be clear, Bitcoin goes back to 80 to 85. I think it then turns lower and actually goes below 50,000.
Well, it hasn't quite gone below 50,000 yet, but it is dangerously close to that level. Talk us through what Bitcoin did since you were on March 13th and made that call, and where you see Bitcoin going next.
Yeah, and so it did play out beautifully on the chart here. We got up to about 83,000, which was right between that 80 to 85,000.
And it was where on March 13th when we had that conversation?
March 13th, it was right here. It was around 71,000, 72,000 right there on March 13th. So it did push up to where I thought it would. Just to show you why the technicals told me that is that if we look at the former pivot lows here, let me get rid of that. If we look at the former pivot lows on the chart, this area right here was where it based before it broke down. When that happens, that's now becoming resistance, right? So it goes right up into that and it gets rejected. And now we're dealing with what it's trying to hold on to is this 60,000, 59,000 level. And it's doing actually a decent job right now. But again, if this level breaks, next stop is 50,000 on Bitcoin. And really you have to look at it. There's a positive and a negative here, is that The positive for Bitcoin is that I'm very sure that money in the crypto markets left the crypto markets for the AI trade, right? I mean, who needs a meme stock that goes up 300% when you can buy a semiconductor that goes up 300% in a matter of weeks or months? And so it did suck money out. Now, the negative side is that historically, if the NASDAQ does have, let's say, a 10 or 20% drawdown, that then could take Bitcoin down. And so, again, I still think Bitcoin probably bottoms out around that 49,000 range. But again, part of me is hopeful because I'm a long-term bull on Bitcoin. I really am. I like the idea. And I, by the way, there's the negative sentiment, the fear, and just the negative commentary from just retail. I don't know if I've ever seen it this bad. I mean, the amount of it's going to zeros on some of my videos for Bitcoin, I've never seen it this big, which also leads me to think there might be a bounce on the horizon. But based on the chart, just watch this. I mean, this is your line in the sand. If we start to really break below it, it's going to 50. If it holds, we might get a bounce. I would say either way, by year end, we've probably broken 50,000 though.
We've broken below 50,000 by the end of the year. What does that mean in terms of where you see Bitcoin ending 2026? Does it continue to drop further down there?
You know, again, this a lot will determine about where the stock market is, but basically what we're looking at here is just, piercing 50K. That's kind of my line in the sand, just like that 54 to 50 level on silver where I would start to accumulate some. You have this area right here where we came up, we consolidated before we had that break up. And this goes back to February of 2024 through basically July of 2024. And this then becomes major technical support. The other thing of interest here for those out there that are kind of a student of history is that every cycle down usually pierces the pre-cycle highs, right? So if we look at this last move here from the 2021 high, you can see once we rallied up, we kind of came back in and we rallied back to the upside there. And if you go to past cycles as well, if we look at our 2017 high, we draw a trend line right across, and you can see we got right below that previous high. And so this 50,000 range would then bring us right below the 2021 cycle high. And I would look at that as kind of saying, okay, we've kind of completed the 4-year cycle drawdown. And listen, I want to be clear. If the stock market really gets into a mess, I have no idea how low Bitcoin could go, but suffice it to say, I'm a buyer at 50 or just sub 50,000.
Well, a couple of points there, Gareth. Firstly, you're talking about negativity regarding Bitcoin. Bitcoin is largely driven by sentiment and consensus. And this cycle, you could make the case, is different from other cycles because of MicroStrategy or strategy and Michael Saylor, because we've got leveraged bets against Bitcoin, unlike the ones that we had in previous cycles. If it does break below certain support lines, and I'm not sure what those levels are in terms of strategies calculations, at which point they start to get in trouble, how bad could the Bitcoin cascade be?
Wow. Yeah. And I've always been against, like, I do not like if you're a believer in Bitcoin, you want it diversified with as many people as possible. And to have one entity owning so much Bitcoin, and there's multiple entities. I mean, if you look out there that own a massive amount, it just isn't healthy for the asset. And so it's possible that the asset tries to squeeze him and push it down. And I will just point this out. Michael Saylor was an oracle back in 2000, right? He had a tech company, and the tech company MicroStrategy was epic in terms of its run up. Look at this right here. It ran up from basically $7 to 330, and then it collapsed 99%. Now, if for some reason he's ever forced to sell, we could be looking at Bitcoin down to 3,000 again. And listen, that's like, I don't want to spread fear, right? I mean, that's not the point. I'm just saying that Michael Saylor has this history of kind of getting too deep in something and then just going all in. And I listen, part of it is, his belief in it is awesome, but it's also a fault, right? And we have to just remember that if any one holder, if he levers up and he has levered up and he's forced to dump his Bitcoin, then who's to say that MicroStrategies doesn't go down 99% again and Bitcoin doesn't fall back to 10K? I mean, it is always possible. I don't think it's likely. I want to be clear on that. I wouldn't be buying at 50K if I thought it was likely, but these are the risks when one holder has that much Bitcoin and they lever it. That's a risk. That's absolutely a risk.
Do you see a scenario where Bitcoin goes to zero?
Oh, man. I don't. It doesn't mean it can't happen. Remember, I'm only right 70% of the time, give or take. But I don't. Again, maybe call me a sucker, or but I'm a believer in Bitcoin. I think it's an alternative to
Mm-hmm.
fiat. It's a way for wealth to be preserved in addition to gold and silver. But again, it's there's always a chance. There's always a chance of anything.
All right, give me your bullish case for Bitcoin
Bullish
from where
case
we
for
are now.
Bitcoin, this would be the bullish case, is that we see an unwind in the AI trade. And as it unwinds, people start to worry about more printing of money as the US economy slips into recession, more debt being added on. And people start to say, okay, we got to go back to gold, silver, and Bitcoin. And you see a money rotation from semis, which have, think about the trillions of dollars, like tens, hundreds, so much money in semis. You take 1%, 2% of that money and put it back into Bitcoin, and Bitcoin's back to all-time highs. And I think that's what us as bulls have to hope for.
So a big print, the Fed coming in, cutting rates, more QE, more liquidity, and the debasement trade back on, bullish for both
Right.
gold and Bitcoin.
Yep, that's what I would say is the bullish case.
And how likely is the bullish case?
Ooh. You always put my feet to the fire. Listen, I still think that there's going to be a lot of volatility in Bitcoin, and I still think a flush to 50 or sub 50, just below 50 is likely. But I do think that there will be a day where all of a sudden things turn around
Hmm.
and people start looking at the Fed starting to be doing these kind of quantitative easing things again. Think about this is generally, during bull periods and good prosperity, the US pays down its debt. Instead, during prosperity, we've only run it up. When do you run up debt as a country? When you're in a recession. But we haven't paid down our debt. So it's just going to skyrocket even faster at higher rates now. And that's the case for Bitcoin, and that's the case for gold. And I think, unfortunately, I think that's a very likely outcome here. You have people going back in the central banks to what worked before, printing money, and
Hmm.
it's going to cause a lot of hardship for a lot of people, though.
Gareth, you always look at the investor psychology and cycles and emotions as well as the trend lines. You always say that markets are driven by fear and greed. So, from your vantage point, where are we in that emotional cycle right now?
Yeah, you're right at the high of euphoria in the stock market, at least. All right. I believe that Bitcoin is a leading indicator. I think gold and silver are leading indicators right now of liquidity drying up. I think the fact that OpenAI is talking about postponing, these are all signals that, as bullish as the sentiment is on the stock market, and I hear this every day, Trump will never let the markets go down. The central banks will never let the markets go down. They'll just print us to oblivion and make asset prices go up. And I would just caution people is that if they do print to oblivion, then all of us are living in massive poverty, a la Germany in the right after World War I, right? You have that scenario. That is not a scenario for prosperity. So yes, they might print, and that's the case for Bitcoin, gold, and silver, but it is ultimately a huge downfall for great citizens and great countries.
Sure, yeah. It's at the cost of your purchasing power, but people are still going to need to put their money somewhere in order to try and maintain that.
That's right.
So, okay, Gareth, you're a chart guy, as we know. What is your top chart that you think people need to look at right now that
Well,
gives?
we've already covered some of them. So gold and silver, we're now getting close to those major buy levels. As much flack as I took when we were north of 5,000 on gold, calling for 3,500, it's finally around the corner. And then I think you have to go to the charts and just look at some of these that are starting to outperform. Look at a name like Kraft Heinz. And again, these aren't sexy, but these are putting in bottoming patterns. They are literally down at levels that, again, you haven't seen since years and years ago. We're down to COVID levels on Kraft Heinz. Is anyone going to stop buying ketchup just because we're at these levels? The answer is no. And honestly, they probably have pricing power because I love my ketchup and I'd pay a little bit more for it. Clorox, these type of names at levels not seen since 2014 that pay a high dividend. I really do think there's a rotational trade here in these names where you could see the dividend getting paid plus 20-30% upside in the next 6 to 12 months in these names.
So, what is the most contrarian call you're willing to make right now? Is that it?
No, I mean, contrarian, that would be that Micron. I would think earlier my Micron. I mean, if I'm saying, in 12 months we see a 75% decline in Micron from here. And by the way, after hours, it's already down nicely here. Not that it's down huge, but it's down, $30 here. I think Micron may have topped today. If not, it's in the next few days or weeks. And I think that we will see Micron back to $450 down here within 12 months. So we can save this tape and play it in 12 months. I'm either going to look like an idiot or I'll look like a genius.
Well, so far, you're looking pretty good based on our previous two interviews. So if you had to rank your top three assets or trades with upside potential right now, what would they be?
So number one right now in terms of upside, that's definitely the high dividend payers in the stock market that have been forgotten and left for dead because that no one wants to play ball with them, even though they pay a great dividend. And they're in industries like food where you're not going to see, like, people can choose to not buy the latest tech, but they still got to eat, right? So that gold, silver, and then Bitcoin if it flushes to 50K. Big buyer, but gold and silver, gold below this 4,000 down to 3,500. I love it. Silver at 50. Oh my gosh, huge level. I've been waiting on this level since it ran up to 120, and we're basically getting to be there.
And we probably have covered it, but in terms of encapsulating this in a final sentiment here, is there a widely accepted narrative right now that you think collapses in 2026?
Absolutely. And I think that goes back to the AI story, how, these companies are priced as if CapEx will only go up, it'll never come down, as demand will only go up, margins will never come down. And that's just not the case. Look at anything historically, and you could say this time is different. I've heard that way too many times. I believed it early on, and I always got burned on it. So just be aware that things will end. It's just a matter of when.
But just to push back on that, people have been conditioned to buy the dip. You've got the rise of passive investing where people don't even know what they're buying because they have 10% automatically deducted from their salaries into their 401ks, which are buying things on autopilot, which are buying ETFs, which are weighted to favor certain stocks. Doesn't this rise of passive investing potentially negate the crash?
It doesn't. And the reason so passive investing has worked so well because the markets have always had these quick dips and then they've gone up. If you have a sustainable dip that, let's say, is 20% and we actually go to 25 and then 6 weeks later we're down 30, you will see the passive investors all of a sudden becoming active investors and starting to panic. And so again, the psychology of the investor here has been conditioned, and I honestly worry that this has been done on purpose. Like in 2007, you had this same mentality before the financial crisis, and then we basically saw everyone get wiped out. I remember people that were going to retire; they ended up having to go back to work because they lost so much, and they panicked and exited at the lows. And then it took how many years until COVID for people to come back, the younger generations to start investing again. I do believe that the exit liquidity is this passive investing, and the big money is already starting to dump.
All right, Gareth, we will leave it there. The oracle on oil, the oracle of oil. We'll see if you're correct in your other calls. We will be touching back with you soon, I'm sure. Probably we'll give you 90 days or so to see how your positions shake out, but always a pleasure chatting with you, Gareth. Thank you so much.
Thank you, Michelle. It is always a pleasure to chat with you as well.
And Gareth, for those that want to learn more about you, how they can follow your trades, participate in some of your services, where can they find you?
Verifiedinvesting.com. It's all charts, no BS. It just is what it is. If you want the hype, go to X or go to social media. Where we do it, we just follow what the charts are saying. Doesn't mean we're right always. In fact, I'm definitely not all right always, but at least I'm right the majority of the time.
And I always like to point out that you are a swing trader, a day trader. You move in and out of positions very quickly as you see the charts change. So I force you into these long-term forecasts, but you're not typically positioned for longer than what? What's your typical duration of a trade?
I would say 2 to 4 weeks is at most. Yeah, at most. And so you're absolutely right. I'm a shorter term trader. Even if the markets drop 20% later this year, have gone long or short 20 times before that happens.
Right. But again, your long-term outlook and forecast on several assets and positions have been accurate. That's why we always love chatting with you, Gareth. Thanks again, Gareth Soloway.
Thank you.
And as always, thank you for watching. If you found this conversation interesting, insightful, educational, entertaining, hopefully all of the above, please be sure to like, share, and subscribe. It really helps us grow this community. And if you would like to learn more about building a precious metal strategy, you can reach out to info@milesfranklin.com. There's a team of specialized advisors and brokers that can guide you according to your personal circumstances. Also, check out milesfranklin.com. As always, please do leave us your comments. We definitely read them. We love hearing from you. So feel free to praise, whine, or just opine. Until next time, stay sovereign.
This is The Real Story with Michelle Makori.